Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news to highlight. Even after last week's rebound, the market is still 4.5% down from last month's high, and investors are still waiting to see if that pullback gets any worse. Fortunately, even if we do see a percent or two lower, it does seem just like a normal pullback before the stock market reaches new highs into this new bull market. For that reason, I'm watching for stocks that could jump higher when investor sentiment improves. Stocks I wish I had bought more of into this year and where the market seems to be giving us a second opportunity. I'm going to highlight the 5 stocks I'm watching, the 5 stocks to buy now for when that pullback ends. Stick around after that. I'll highlight the stocks I'm watching this week and the economic news you need to see. Well, first, I'm relaunching our custom portfolio tracker with a 33% discount. This is so much more than just a stock portfolio tracker where you put in your stocks, how much you pay, the number of shares. It's going to tell you the sector, the industry. It's going to download all the prices off of the internet, even tell you how much of your portfolio you have in each. You can put in 2 stocks to compare them side by side, as well as compare them against their sector averages. The spreadsheet downloads directly from the internet all the most important measures like price to earnings, price to sales ratio, gross margin, operating margins, everything you need to know to make a better choice. Here in this Investing Goals tab, you can put in your age, years until you want to retire, and how much you invest each month. It's going to automatically estimate your portfolio at retirement based on your stocks you're holding right now. This is a complete stock portfolio and financial goals spreadsheet. And again, I'm relaunching it with a 33% discount. You're going to get lifetime access to all the updates to the spreadsheet, the videos that teach you exactly how to use it and how to reach your goals. So look for that special promo link in the video description below. That 33% launch discount is for a limited time though, so make sure you check that out. Back to those stocks to buy that could jump higher after this pullback, though. A citizen of the Bowtie Nation in our Facebook group here asked if I would make this video on stocks that I thought could rocket higher after the pullback. The more I thought about it, though, all I could think of was Chevy Chase by the pool in the original National Lampoon's Vacation movie going, "This is crazy, this is crazy, this is crazy."
This is crazy. This is crazy. This is crazy.
And that's because I usually try avoiding those kinds of short-term stock trading ideas because, well, nobody knows, folks. These videos go out to tens of thousands of investors, and I don't want someone jumping into a stock just because some bozo in a bow tie on YouTube assured them that it was going to make a lot of money really fast. But I do believe the recent pullback is giving us some great opportunities, making valuations on some of the best long-term growth names more attractive. So I wanted to highlight those. So here I'm thinking of those growth industries that are just changing the world in which we live. I'm thinking of things like digital banking, sports betting, cybersecurity, AI, electric vehicles. These growth stocks are a major focus of my portfolio, but they always seem to be just too expensive on valuations until now, right? All were up double digits through the first 7 months of this year and are now pulling back, falling fast in this pullback. That said, we could still see a percent or two in this market pullback, which would translate to even a bigger hit in these growth stocks. But I would much rather be early in increasing my positions, buying in at these lower valuations, and once again missing out on them, and wish in a year from now, when the valuations are and prices are higher, that I had bought more. So before I reveal those 5 stocks I'm buying, my criteria for these were one, a growth industry changing the way in which we live, right? That means most of the stocks in that group are going to get a tailwind to drive them higher. You don't have to necessarily be fortunate enough to pick the very best in the group, the leader, because all of those stocks are going to run higher as those growth stocks take off. 2, a leader or a dominant market share in that group, right? I want the companies with a competitive advantage in that industry. So not only are we looking at a growth industry, but a stock that is dominating that growth industry. Also, stocks that were doing well on that positive investor sentiment in the rising market, but sold off on that pullback. Okay, basically, I'm trying to filter out the companies with specific problems to invest in the ones that are going to bounce back when the market does recover. And the first one here probably won't surprise anyone out there in the Bowtie Nation. Shares of SoFi Technologies, ticker SOFI, were up 155% this year before plunging 28% over the last few weeks. This is a major part of my portfolio. In fact, this is the second largest position in my portfolio. I love SoFi as a leader in that fintech banking, which is expected to grow revenue by 30% this year, adding millions of users every quarter. And this is one of the few banks that continue to grow those deposits through the recent banking crisis. It's not as cheap as when I started buying last year, but it will be a major bank, and we have a long way to go over the next few years. This is the second largest position in my portfolio, and I'm adding more on this backup. DraftKings, ticker DKNG, also already a part of my portfolio, holds a commanding lead in that sports betting and online gambling, about 25% of that market. It is second only to FanDuel in the market share. Now, the shares were up 193% this year before falling back 13% in that pullback. Revenue is expected to surge 58% this year as the company really expands into more states and expands its services in each of the states it's in. It's still in only 18 states, with gaming and sports betting getting the legal go ahead in more states every single year. Next year, Fortinet, ticker FTNT, beat its earnings expectations, but gave a weak third quarter outlook that really blasted the shares recently. The stock was up 67% from January, but then plunged 27% on that earnings results. You can see that in the graph here. The company is still expected to post 22% sales growth this year, and cybersecurity is one of the strongest growth trends over the next 5 to 10 years. Really, this outlook could go to any cybersecurity firm. We're going to see CrowdStrike report its earnings this week. I'll talk about that later. We talk about other names on the channel here. Zscaler is another favorite cybersecurity name here. Any of these cybersecurity firms pulling back in this would be a good bet. FTNT here and its peers are rarely as attractive as this in value territory, so this might be a rare chance to get into a position. I started buying Rivian Automotive, ticker RIVN, late last year, and tired of just missing out on that EV trend with Tesla and believing that the smaller rival, the smaller car maker, was close to an inflection point in that production and cost. Basically, it was about to get to that size of production that where its costs started coming down fast. I didn't realize that shares would be up 59% in the first 7 months of this year. So I was just kicking myself for not buying more. And now this 26% drop has me back in the market for more shares. Revenue is expected 160% higher this year and 63% higher next year. And those production costs per vehicle are falling. Even a fraction of the EV market here would make Rivian a major player in car manufacturers and a great return from here. I'm focusing on Snowflake, ticker SNOW here, but the same could probably be said for Palantir, ticker PLTR, and a lot of these other AI software stocks. We talked about this in our live stream last Thursday about how the software and the cloud services stocks were really the next step in this AI boom that we're seeing. The chip makers, it's a crowded trade. They're very expensive chip makers like NVIDIA, like AMD, very expensive right now, but these software stocks, these are the next ones to boom. Snow was up 45% this year before that pullback shaved another 19% off that stock price. I pointed this out in Thursday's live stream. Go back, watch that. While the chip makers like NVIDIA remain extremely expensive, that next big trend in AI will be in the cloud services and these software stocks. We're building that ability to process the AI with that semiconductor advances, with NVIDIA's chips. Next is going to come the demand for that software itself. And that is where these companies like Snow come in. Those are the stocks I'm buying, the ones I think could jump after this pullback. Now, I want to highlight the stocks I'm watching this week, the ones with earnings, the ones with other announcements this week. First up here is CrowdStrike Holdings, ticker CRWD. It's going to be reporting its earnings Wednesday after pure cybersecurity firm Palo Alto Networks really helped bring investors back to this industry with its earnings. So, Palo Alto Networks, ticker PANW, reported its earnings the Friday before last. A lot of people were wondering why it would report Friday after the close. We're really worried it might have something bad to say. It came out with a market beating estimates and outlook, drove that stock up like 10, 12% higher, brought a lot of people back to these cybersecurity firms after they had been hit in the pullback. Now, CrowdStrike rose 2.7% last week, but is still down 9% from its recent peak. Sales are expected higher by 35% this year and 29% next in this, again, fast growing market. Cybersecurity stocks have been a target of mine, but always traded so expensively. So I'm taking advantage of this recent sell off to pick up more shares at these better valuations. Salesforce, ticker CRM, is also going to be reporting its earnings on Wednesday, with the pullback having taken 11% off these shares over the last few weeks. While growth has slowed dramatically for this company in the last couple of years, revenue is still expected 10% higher, and CRM is one of my 5 forever stocks that I'm buying. Really, the stocks over the next 30 years, I think could lead. It's a leader in the HR and customer management artificial intelligence space, and I think really going to benefit from that as well as the cloud services area. This next one is really interesting to me. Something I learned about in a Wall Street Journal article just recently. Toast, ticker TOST, missed its quarterly earnings badly on the Q2 earnings and is down 16% from the recent high and way down from the 2021 conversion from a SPAC. But I'm taking a closer look at this restaurant software provider. Okay, with the trouble restaurants are having just in their staffing, trying to keep people working for the restaurants. This is a booming industry, and shares trade for just 3.3 times sales. That is a steal for a company booking 30% plus sales growth. So we have a growth stock here, still with those high double digit sales growth numbers, trading for like a normal company for 3.3 times sales, just because it was one of those pandemic darlings that people have since sold off. Company has a net cash balance sheet and reached EBITDA profitability this year. So if as I do my further research, I want to make sure that it has that competitive advantage among its industry peers. It's clearly a growth industry, this automation, software automation for restaurants. If I can find that Toast has a competitive advantage, it's going to be able to keep up that growth rate in this growth industry. I'm going to be backing up the truck on this one. I'm highlighting Ford here, but really all the car makers are down hard over the last month, with most falling double digits. Even new kid on the block Tesla is down 13% over the last few weeks. It has me taking another look at some very attractive valuations in an industry that could see some very strong growth on EV sales over the next few years. Ford here is expected to post nearly 10% sales growth this year, which is unheard of for those legacy car makers, and trades for less than zero point 0.3 times revenue. It's also on less than 6 times on a price to earnings basis. So all this while paying a 5% dividend yield. If Ford can kind of get the kinks worked out of its F-150 Lightning, that EV version of the truck, it is going to see monster sales growth and very strong returns from here. Giving you the bigger picture, here we are on sectorspiders.com, the sector tracker, one of my favorite free resources on the internet. We can see here over the last 5 days, 7 of the 11 stock sectors closed higher last week, with tech once again regaining that leadership. This is something we've been talking about over the last couple of months, really worried that if tech could not bounce back, then the S&P 500 would have a very difficult time going higher, because tech is such a big part of that index. Tech is like 27% of the entire stock market index. The rest of the market was noticeably weaker, though, with cyclical sectors here like materials and industrials noticeably lagging. Bigger picture trend I wanted to talk about was the outlook for higher interest rates from the Fed. With stubbornly high inflation and a strong jobs market now expects another interest rate increase from the Fed at the November meeting. Here we are on the Fed Watch rate tool by the CME, and we can see here the probabilities, market probabilities or expectations for Fed interest rate increases or decreases over the next year. We do see here that the highest probability is 80% that the Fed will hold steady here in its September meeting, but the market is now expecting 48% chance. So the highest probability that it will raise rates here in the November meeting, or at least once over the next 3 meetings into the next year. Market does still expect a rate cut here in March. That would just return it to that 525, 550 basis points interest rate, though. That idea that rates will remain higher for longer really means these rate sensitive sectors like utilities, like real estate, are going to have to wait longer for the catalyst that could send them higher. Here we see over the last year, both of these sectors really getting hit hard on those higher interest rates. Stocks in both sectors down more than 17% each. High bond yields are pulling investors out of those safety stocks like utilities, like consumer staples. Really, why should you invest in those safety stocks when you could get a 5% plus bond yield, much safer bonds than even some of these utilities and consumer staple stocks? Within real estate, obviously very highly leveraged, compounding other problems in the market. It's going to keep prices weak. It may be a few more months, but investors should be watching for these sectors, because I still believe once we do get closer to those interest rate cuts and into those rate cuts, it is going to be supportive of the stocks in these sectors. And these could be the ones to buy, these stocks in the real estate and utility space. We do see 2 opportunities for stocks to break out of that pullback this week, or maybe even fall further into it. On Thursday, we see the latest inflation report with personal consumptions expenditures report. That's the PCE. This is the preferred inflation gauge used by the Fed, and it's expected to show core inflation is actually going to increase a little bit to a 4.2% annual pace versus just 4.1% last month. Now, we as investors have been spoiled with a smooth path lower in inflation over the last year, and I'm afraid we could be in for a harsh reminder that real price pressures just don't fade so normally. If the report is above expectations, the market is going to take it as a sure thing on more rate hikes, and that could mean stocks are in trouble, at least for this week and the next couple of. Of course, the bigger news this week is going to be that monthly non-farm payrolls report on Friday. Market is now expecting the U.S. to have added just 165,000 jobs last month. That'd be versus about 187,000 jobs in the previous month. Hourly wages also important because it affects that inflation idea, as they're expected to show the same pace of growth, about 4.6% on an annual basis, as was reported in the last month. Inflation and unemployment is expected to stay at that 3.6% rate as well. A weakening jobs picture could actually be a good thing, though, here, especially after if that PCE report is a little bit higher than expected, because it's going to show that the economy is slowing down and may allow the Fed to hold off on those rate hikes. Make sure you take advantage of that special 33% relaunch discount and get your portfolio tracker spreadsheet with the link below. Or click on the video to the right to see how to get free money in retirement. This is a special strategy that beats all the traditional retirement strategies. Make sure you check that out. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.